Hello, everyone. Thank you so much for joining us. This is our first weekly wrap-up of 2025, and Happy New Year. My name is Jeremy Kronemeyer. I'm Operations Manager for Wickham Financial Group, and I have Graham Wickham here, President and CEO of Wickham Financial and Insurance Services. Graham, what happened last week?
Yeah, thank you, Jeremy. And thanks for our listeners jumping on the call. As Jeremy mentioned, it's our first of the year, so we have to get ourselves back in the groove. But I hope everyone had a great, safe holiday with friends and family and loved ones as we look forward to this new year. But let's wrap up, and then we'll talk about kind of the week ahead. That's kind of how these calls go. Just short and sweet if you're kind of new to it. But from a U.S. equity standpoint, we did see the end of 2024 down a little bit, but it was a strong annual returns. We saw the Nasdaq Composite up about 28%, the S&P 500 gained about 23%, and the Russell 2000, that's a small cap index, up about 10%, the Dow up about a little bit more than that. We saw international equities, emerging markets rise about 5%, and the developing side of the international markets rose about 1%. So a pretty big difference compared to the U.S. Side of the markets. If we look at the S&P 500 sectors, what were the best performers? No huge surprise to everyone if you've been a student of it. We saw communications up about 33% on average, financials up about 28%, consumer discretionary up about 25%, technology up about 20%. It was giving up a little bit of room throughout the year, but picked up some steam towards the end. Real estate, healthcare, materials, and energy all lagged. And I think materials were actually down on the year. If we looked at cryptocurrency, huge run for Bitcoin. That started out about 42,000, ended up at one point over 108. But for the year, it was up about 122%. Now, if we go in the commodity area, gold jumped. Safe haven type trade, if you might, up about 27%. Oil prices were pretty volatile, but they did end nearly unchanged at about 71.78 per barrel at the end of this last year. U.S. Treasury yields were flat to down on the shorter end, but if we look at the longer end, 2030, we did see yields higher. We did see an inversion, reinvert, if you might, or exit its inversion in the fourth quarter. I'll get that right. But the economic data, so flowing over there, we saw retail sales rise about 3.8% during the holiday. Unemployment claims did fall to an 8-month low. On U.S. manufacturing, the PMI increased to about 49.3, and new and pending home sales that did rebound, but existing home sales still stayed really low and slow because of the 30-year mortgage still on that higher side. Listen, we went through years of these lower mortgage rates. It's hard to digest, at least for that side of the market. Just shy of 7% on the 30-year mortgage. Consumer confidence that fell in December due to some concerns over some politics, maybe the new administration coming in, as of January 20th, and some tariff talk, immigration talk, which could be pro-growth, but at the same time could be pro-inflation. Not that they want inflation, it just might heat up the economy a bit more. Overseas, we'll look at the China's economy. The World Bank did raise some growth forecasts for them, but they warned on some real estate downturns. Japan economy inflation did edge higher. The BOJ's board is divided on some further rate hikes with Japan. If we look at kind of the week ahead, Thursday, we're going to be looking at the U.S. equity markets are going to be closed. The bond market will be closing earlier, and our national day of mourning for former President Carter passing away. We look at U.S. economic data. We'll have the focus on monthly unemployment data. We'll look at the FMOC, Federal Open Market Committee's minutes, kind of check the direction of the team over there. We'll look at some key reports with JOLTS job opening, ADP private payroll, some Challenger job reports, some other payroll numbers, and then we'll be looking at the Federal Reserve. We'll be looking at those minutes in a bit more detail to see where rate cuts might come into play, even though at the end of last year they did lower their expectation for rate cuts for 25 down to, I think it was around 2. Look at some U.S. data. We'll look at the Treasury auctions, ISM, PMI numbers, manufacturing, consumer credit numbers. And then internationally, it's all going to be about inflation. We'll be looking at Europe, China, Australia, Europe to get our clues on how they're handling and managing inflation on the other side of the pond. Jeremy?
Gotcha. Well, Graham, I had a question for you. So since we ended the year pretty strong across most of the indices or all the indices, what do you see for kind of outlook starting the year up strong for 2025?
Yeah, and we probably mentioned this right before the holidays when we did our last ones for calls for last year. Wouldn't be surprised if we get some volatility. Maybe some people held off taking some gains on the stuff that worked the best, those best performing sectors and stocks. Maybe they start taking some after the first of the year. But at the same time, the money never really leaves the markets per se. It always finds another home. So maybe it goes into undervalued, underappreciated areas. Maybe fixed income maybe gets a little bit of a lift. Remember, I think we have $6-7 trillion in money market type accounts that as the Fed lowers interest rates, they're making less money. So maybe they need to find a home. It could find itself in equity market, but maybe on the value side, small, mid cap, maybe a little international, maybe some of that fixed income area that's lagged the last part of last year.
Got it. Well, we always appreciate the expertise, Graham. Thank you so much. And to our listeners, we do have our retirement planning today. Our first class is coming up on January 28th on Tuesday, and then the following Saturday as well. So just go check out our website for more information on that. If you have any questions, give us a call here at the office, and we look forward to seeing you next week.
Take care.